Every time a major empire falls, the history books obsess over the last battle. But if you zoom in on the money, the collapse usually starts long before the final soldier surrenders. In the early 1600s, the Ming Dynasty ran one of the most sophisticated economies on the planet. They had a vast bureaucracy, a massive population, some of the world's most advanced technology, and trade networks that stretched across Asia and all the way to the New World. And then, in less than 50 years, the whole thing came apart. Not because of one catastrophic battle. Not because they ran out of soldiers or walls or fancy titles. They ran out of money first. More specifically, they ran out of silver, the metal their entire tax system depended on, and that broke everything else from the inside out. This is not dusty trivia. It is a case study in what happens when you build a financial system on the assumption that one critical flow will never stop. Today, we do not use silver as the backbone of our money, but we do have our own hidden dependencies. We rely on low interest rates, on dollar liquidity, on credit markets that most people never think about, but that their entire life quietly sits on top of. So in this video, we are going to walk through exactly how Ming China's silver-based money system collapsed, what that meant for ordinary people caught in the gears, and what you can learn from it, so you are not the financial equivalent of a tax-paying peasant in the wrong currency. In other words, how to protect yourself in a world where the rules can shift faster than anyone expects. If you are new here, this is Money Margins. We take weird moments from financial history and turn them into simple playbooks for your own money, without the doom or the jargon. Let us get into it. The Ming Dynasty ruled China from 1368 to 1644, almost 3 centuries. At its peak in the 1400s, this was a true superpower. The largest navy in the world, massive fleets sailing across the Indian Ocean. A home base that produced silk and porcelain Europeans would practically sell their cousins to get. But by the 1640s, the empire was imploding. Rebellions, famine, unpaid troops, and finally, conquest by the Manchus, who built the Qing dynasty on top of Ming's ruins. The interesting question is not, did they fall? We all know they did. The real question is, how does a state that wealthy and powerful lose control that badly? The usual answer is a greatest hits playlist. Weak emperors, corrupt officials, foreign invaders. And sure, all of that was there. The real collapse started in the money system. At a high level, the pattern looks like this. Tie your entire tax system to one kind of money you do not control. Assume the supply will never really change. Then act surprised when the whole thing seizes up. The Ming government built a tax and payment system that required silver, a commodity they did not produce in large enough quantities at home. They had to import it. When those imports dried up, the entire financial structure of the empire seized up. Tax collection broke down. The state could not reliably pay its army. Local order started to fray. This matters for us because we live in a system with similar hidden dependencies. Most countries rely on currencies and credit flows they do not fully control. Most individuals have obligations tied to interest rates, inflation, and policy decisions made in rooms they will never sit in. Understanding how the Ming system broke gives you a mental model for spotting similar weak points in your own financial life. It is not about memorizing dates. It is about learning to ask, what is the one flow my plan assumes will never change? Let us start with how China ended up building a silver trap for itself. Earlier in Chinese history, the government had experimented with paper money. It worked for a while. Then the government did what governments tend to do. They printed more and more and more, and eventually inflation took off and people stopped trusting it. Turns out, just print more has been a bad long-term strategy for a very long time. It sounds familiar, does it not? By the late Ming period, they wanted something more stable. Something people actually believed in. Silver became that anchor. The key change was called the single whip reform, rolled out in stages starting around the 1530s. In simple terms, it took a messy pile of different taxes and obligations, things like grain deliveries, labor service, and random local fees, and rolled them into one primary tax payment that was increasingly required to be paid in silver. On paper, this looked like efficiency. One tax, one payment, cleaner administration, fewer spreadsheets, Ming edition. But here is the catch. Most ordinary people in Ming China did not earn silver. Peasants grew rice or wheat. Artisans made tools or cloth. Village trade used copper coins or straight-up barter. But now their tax bill was in silver. So if you were a farmer, your situation looked something like this. You work your land. You harvest your grain. You sell part of it in the local market for copper coins. Then tax season arrives, and now you have to convert those copper coins into silver for the government. If silver is cheap relative to copper, you manage. If silver becomes scarce or expensive, you are in trouble. Nothing changed about how hard you worked or how much food you grew. But your tax burden just went up in real terms, because the metal your taxes are priced in went scarce. This is like earning your paycheck in dollars, but your mortgage and tax bill suddenly being denominated in euros. If the exchange rate moves against you, you are getting squeezed, even if your salary stays exactly the same on paper. That is the fragility the Ming baked into their system. They made everyone's obligations dependent on a commodity most people did not directly earn or control. It looked stable because silver felt hard and trustworthy. It was actually fragile because the entire thing depended on a pipeline from the outside world. So where was all this silver supposed to come from? China produced some silver domestically, but nowhere near enough once the tax system demanded it at scale. The answer was trade. Huge amounts of silver flowed into China from two main sources. First, Spanish America. After the Spanish conquests, they discovered huge silver deposits, especially at Potosí in what is now Bolivia. This was basically a mountain of money. Spanish ships hauled that silver across the Pacific via the Manila Galleon trade route, from Acapulco to Manila and then into China and the rest of East Asia. Second, Japan. Japanese silver mines were very productive in the 1500s and early 1600s, and a lot of that metal flowed into China through regional trade networks. Why did all this silver end up in China? Because China had what everyone else wanted: silk, porcelain, tea, high-value, high-status goods. So silver would leave the mines in the Americas and Japan, get pushed through this global plumbing system of merchants and middlemen, and pool in China. China became a kind of vacuum for silver, trading finished goods for raw money. From the Ming government's perspective, this looked awesome. Silver keeps coming in, taxes get paid, the bureaucracy gets funded, the system looks stable. But there is a hidden assumption underneath all of this. The assumption is that the silver will always keep flowing, that trade routes will stay open, that Spain will keep shipping, that Japan will keep exporting. As long as those assumptions hold, everything is fine. But assumptions about infinite flows are dangerous. It is the same logic we see today. The global financial system assumes that dollars will always be available, that credit markets will always function, that interest rates will stay within a nice, comfortable range. Until they do not. By the early 1600s, the silver pipeline started to crack. Spain, despite all that American silver, was in serious financial trouble. The Crown had been fighting wars across Europe for decades, borrowing heavily and defaulting on its debts more than once. As Spain's finances deteriorated, the government became more protective of its silver. Flows to Asia slowed. At the same time, Japan's politics shifted. The Tokugawa shogunate consolidated power and began tightening control over foreign trade, including silver exports. They were not interested in watching their silver pour out of the country forever. So Japanese silver exports dropped sharply. On top of that, piracy, privateers, and general conflict made long-distance trade more expensive and less reliable. The end result was simple: less silver made it to China. But the Ming tax system did not really adjust. It still expected everyone to pay in silver. So you now have a shrinking pool of silver and a fixed tax demand priced in that silver. When that happens, silver becomes more expensive relative to everything else. If you are a peasant trying to turn your grain or copper coins into silver to pay taxes, your life just got a lot harder. Your harvest might be normal. Your local income might be stable. But the amount of silver you can get for it is shrinking. Tax arrears start piling up. People cannot pay. Some sell land or possessions just to meet obligations. Others stop trying and simply fall behind. Local officials find themselves squeezed as well. They are supposed to deliver a certain amount of silver up the chain, but they cannot collect enough locally. So they either get ruthless with the people below them, or they start faking the numbers above them, or both. What started as a monetary problem is now bleeding into everything else. Now stack on everything else that was going wrong. In the 1630s and 1640s, northern China went through severe droughts and crop failures. Famine spread. At the same time, corruption and mismanagement among officials got worse, not better. When the money system is breaking, that is usually when the worst behavior comes out. Rebellions started popping up. Bandit groups turned into full-scale insurgent armies. The most famous rebel leader was Li Zicheng, a former postal worker who eventually commanded a massive rebel force. By 1644, his troops captured Beijing itself. Meanwhile, the Ming military was struggling. Not because China forgot how to recruit soldiers, but because the government could not consistently pay or supply them. Remember, the state's revenue was collapsing in real terms. Tax collection, based on silver, was breaking down. When you cannot pay troops, they become less reliable. When they become less reliable, local elites get nervous. When everyone is nervous, loyalty goes on sale. So when the Manchus, a rising power from the northeast, stepped in, they were not conquering a confident, well-funded empire. They were stepping into a vacuum. The Ming state had already lost control from the inside. The money system failed first. Military defeat came later. By the time the Manchus moved through the Great Wall passes and took Beijing in 1644, the Ming Dynasty was already functionally finished. Here is the key point worth underlining. Ming China did not just lose a war. It lost control of its money, and that made everything else impossible. When you cannot collect taxes, you cannot pay troops. When you cannot pay troops, you cannot maintain order. When you cannot maintain order, you lose legitimacy. And once you lose legitimacy, it is only a matter of time before someone else steps in and takes your place. The collapse did not start with foreign invasion. It started with a broken currency system. So, what does any of this have to do with you, your job, your mortgage, and your grocery bill? We are not using silver anymore. We are not living under the Ming Dynasty, but we do live in a world full of similar hidden dependencies. Think about how many countries today owe debts in a currency they do not control. Emerging markets borrow in dollars or euros. If those currencies become scarce or more expensive, they end up in a position that looks a lot like the Ming peasant trying to pay taxes in silver. Their local economy might be fine. People are working, businesses are open, but their obligations just became harder to meet because the money they owe is suddenly more valuable than the money they earn. Or think about how much global trade and finance depends on liquidity from a few big central banks, like the Federal Reserve and the European Central Bank. When credit is flowing and interest rates are low, everything looks stable. Politicians declare victory. Markets climb. Everyone relaxes. But when that flow tightens or reverses, the strain shows up fast. Loans roll over at higher rates. Risky borrowers struggle. The weakest links start to snap. For individuals, the dynamic is similar. You earn your income in one basic unit, which is your salary and your local economy. But your biggest obligations might be tied to things you do not control. Interest rates, inflation, policy decisions. A household that can easily afford a mortgage at 3% might be in serious trouble if that rate jumps to 7% and stays there. A retiree living on a fixed income might be comfortable at 2% inflation, but gets squeezed badly if prices keep climbing at 8% for several years. Your day-to-day habits might not change, but the rules of the game around you did. Here is another version of the same problem. Many people assume housing prices will always go up in the long run, or that stock markets will always bounce back fast, or that their job in a safe sector will always be there. Those might be reasonable assumptions most of the time. They might even be true over 30 years, but they are still assumptions. And when the underlying flow, whether it is credit, confidence, or demand, changes, those assumptions break. The lesson from Ming China is not that everything is guaranteed to collapse tomorrow. This is not a doom countdown channel. The lesson is that the real danger is not just cartoon villains or bad luck. It is building your entire system on the assumption that one key flow of money, credit, or some critical resource will never really change. That is what makes systems fragile. And it is what makes people vulnerable without realizing it. So, what do you actually do with this, other than win obscure history arguments on the internet? Before we go tactical, a quick disclaimer. Nothing in this video is financial, legal, or tax advice. It is education and opinion. Your situation is unique, so talk with a qualified professional before making big decisions with your money. Now, let us talk about a few practical ideas. First, do not be the peasant paying in the wrong currency. Try to match your biggest obligations to what you actually earn or control. If you are taking on a mortgage or any significant debt, ask some uncomfortable questions. Would I still be okay if interest rates doubled? What if my income dropped by 20%, even temporarily? If the honest answer is absolutely not, that does not mean you never do it. But it does mean you should label that risk clearly in your own head and consider a backup plan. Be cautious with commitments that are indexed to things far outside your control. Variable rate debt. Obligations tied directly to inflation. Bets that assume one asset class will always go up quickly enough to bail you out. Second, diversify your money ecosystem. This is not about trying to outtrade Wall Street or hit some perfect portfolio allocation. It is about not having one brittle failure point. If all your wealth is in one asset, one currency, or one income stream, you are fragile. Think in simple categories instead. Some cash or liquid savings for short-term shocks. Some harder assets, like real estate or inflation-protected securities. Maybe a small allocation to commodities or precious metals, if that fits your situation and risk tolerance. And do not forget the least talked about asset, which is flexible skills and relationships that give you earning power if one path closes. The goal is not maximizing returns. The goal is building resilience. Third, stress test your plan. Ask yourself, out loud if you have to, if this one assumption changed, what breaks first? If interest rates stay higher for years instead of months, does my plan still work? If my industry shrinks or my employer has a bad year, how long can I stay afloat? If inflation stays elevated and my savings slowly lose purchasing power, what is my plan B? You are not trying to perfectly predict the future. No one can. You are trying to identify your weak spots while you still have time to do something about them. And finally, think like the Manchus, not the collapsing court. When the Ming system was unraveling, the people who got crushed were the ones fully committed to the old setup with no reserves and no flexibility. The people who survived, and the ones who eventually took over, were the ones who had options. They had resources, room to maneuver, and the ability to step in when others were forced out. For you, that means keeping some reserves. Financial reserves, but also psychological and relational ones. An emergency fund, so you are not forced to sell or panic at the worst possible moment. Skills and relationships, so you are not completely dependent on one employer, one location, or one business model. Position yourself so that if other people are scrambling, you have at least a little bit of room to breathe and choose. None of this is about being paranoid. It is about being prepared. Ming China built a system that looked strong from the outside. It collected silver, paid its officials, and ran a huge empire. But under the hood, it depended entirely on a flow of money it did not control. When that flow slowed, the empire did not fall because its enemies suddenly became superhuman. It fell because its own system was fragile. The same pattern shows up again and again in history, and versions of it are baked into today's economy too. You do not need to predict the exact way things might break. You just need to look at your own financial setup and ask one simple question. Where am I assuming a flow will never stop? And then start building some resilience now, so you are not the one caught off guard when it does. If you want more breakdowns like this, where history meets what to actually do with your money, subscribe to Money Margins so you do not have to navigate this stuff alone. Thanks for watching, and I will see you in the next one.